Hey YouTube, Jason here with Day Trading Fearless. Welcome back to my channel. If you're new, welcome. Make sure you guys hit the like button and also subscribe. And all these option videos are sponsored by myself. So these are the weekly trade zones for the S&P Emini futures. $50 one-time payment for a lifetime subscription. I've been doing these for about 7 or 8 years now. And every weekend I send you all these trade levels. Again, $50 only. Go to daytradingfearless.com or click the link down below in the description. And also make sure you check out my Patreon page at patreon.com/daytradingfearless to follow along with my trading portfolio. So, with that being said, let's jump into the option video course, and I hope you guys enjoy it. And thank you for watching. In this video, we're going to talk about calendar spreads, okay? So now we're going to start getting more into spreads. Anything a spread is usually 2 or more options, just FYI. So, calendar spread. Opinion, bullish, bearish, or neutral. A calendar spread is a spread that uses calls or puts and can be a short-term neutral trade or a longer-term bullish or bearish trade. The position is created by purchasing a long-term option, a back month option like the October expiration, and at the same time, selling a shorter-term option, a front month option like the July expiration with the same strike price, right? So with calendar spreads, you want the same strike price, but you want different months on it. So you will typically use a slightly out of the money strike price in anticipation of a sideways move in the underlying stock through options expiration of the option that you are short and keep the full premium that you collected. If the short option expires worthless and if you are still neutral on the stock, then you can sell another near-term option with the same strike price. This is called rolling your position. Finally, you can simply remain long the further out option if your outlook is more bullish or bearish at that time. So here's an example. Current stock price is $20, right? You want to buy one XYZ January call and you're going to pay $1.75. You then sell one XYZ October 20 call and you're going to collect a $1 credit. So here's a good example of. So what we would do is we would come over here and let's look at the 40. This one's too far out. So let's go out to September, right? And let's do the 42s. Okay, so if we do the 42s, we would buy the back month, right? We could buy these back month Septembers for $5.30, right? We then could sell the front month 42s for $2.60, right? Well, think about this. If this stock goes sideways, right? At the end of, let's say the stock's at $42 exactly. At the end of May, these options will expire worthless. They're worth nothing, right? Because the stock's at 42, so there's no intrinsic value. And so we're going to collect $260, but because we still have all the way out to September, the time decay is not that much. Maybe we would lose $100, right? Maybe these 42 calls would be worth $4.30. Well, we would lose $100 here, but we would make $261 here. Net we'd be up about $140 $30 on the entire trade. And then we could go out to June and roll and just sell the Junes and stay long this, right? Expire or let those expire worth less, roll into the June, maybe collect another $2.50 or something like that with the price being at 42. Now there's zero risk on this trade because remember, we paid $5.30 for these calls. Well, if we've collected 260 and we collect another 260, now there's no way we could really lose money on this trade. So that's kind of how the calendar spread works. So let's look at an example. You will buy one XYZ December 20 call and sell one XYZ October 20 call. You will want the stock to trade sideways and close just below $20. So the near-term month, October 20 calls you sold will expire worthless and you keep the full $1 of premium you collected. At October expiration, you will only be long the January $20 call. And then you can sell a November 20 call to collect more premium, maybe another $1 if you think the stock will still trade sideways. This is called rolling the position. Or if you want, you could just stay long the December 20 call if you think the stock will make a move higher. And the reason you would do that is because you've literally lowered your cost basis. Let's say this December 20 call, you paid $2 for. Well, if you already collected $1 and it's sideways, you could say, hey, I'm bullish going into December. I've already made $1. I paid $2 for that option. So now I only have $1 worth of risk and I'll let that ride. So that is how calendar spreads work. Really good. Now, just a little tip. You want to put calendar spreads on in low implied volatility markets, not high implied volatility. So that's a calendar spread. And until the next video, we'll talk to you soon.